Welcome to the self-intimacy journey, a space to transform heartbreak into ecstasy, a space to fall deeply in love with yourself and embrace a level of self-intimacy you've never known before. Alas, allow yourself to dance with your demons and fully accept all of you. Your host, Charlene, the Intimacy Maven. Hello. Welcome again to the self-intimacy journey here with Mark Holohan, and we will be discussing debts and credits. So in the last episode, we discussed budgeting and saving, and today it is debt and credit rating. So let's do it. So what is debt and why is it important to manage?
Well, debt is borrowed money, and it can be a wonderful convenience for allowing us to enjoy goods and services sooner than we would have if we had to accumulate the money before buying them. Imagine how hard it would be to buy houses and cars if we could only buy them with cash on hand. It can also be very helpful in emergency situations, and there can even be travel or cash rewards in using some credit cards. The disadvantage is that debt creates an obligation to continue paying not only the original amount borrowed, but also interest costs and sometimes other fees for using the money. This obligation continues regardless of what happens to our income or other expenses. People get into trouble when they borrow more than their income can safely support. Also, debt repayment is another category of spending which is competing with savings for a share of income in a wealth building effort. This is a key area where overspending affects our ability to build financial resilience. If we miss debt payments, we get penalties. Perhaps we forfeit assets like cars securing the debt. We may even have problems getting debt at affordable prices, and we can even have to declare bankruptcy to recover from excessive debt.
And what are some debt basics to know?
Debts have a principal amount borrowed, an interest cost, a repayment length of time or term, and a regular payment. Monthly is the most common for consumer debt. Installment loans typically have level payments and fixed interest rates. Revolving loans have changing amounts borrowed, interest rates that change, and payment requirements that change. Increasing the length of the repayment period can lower the monthly payment, but that increases the total interest paid. Interest costs vary with factors such as the type of loan, the borrower's credit rating, whether the loan is secured by pledging an asset for collateral, whether the interest rate is fixed or variable, and banking industry conditions. Be sure you know about all the charges that go with a loan and watch out for other terms like prepayment penalties and late payment charges.
And what is an annual percentage rate?
Interest charges can be confusing since rates can be expressed as daily, monthly, or other intervals. Lending laws have established the annual percentage rate, or APR, as a uniform way to compare the true cost of borrowing money for a year. And you should always look at that value when making your borrowing decisions. The Truth in Lending Act requires that lenders disclose the APR, the finance charge, the amount financed, and total payments in a statement they provide you before you close a loan.
Do APRs vary much among loans?
Absolutely, they do. And consumers can save a lot of money by getting low rate loans and avoiding predatory loans. Home loans or mortgages often have the lowest interest rates. They're well under 10%, since a lender gets the right to take possession of a house if payments aren't made. The payments are low compared to the amount borrowed, since the repayment term is often 30 years. Other loans have shorter repayment periods and higher interest costs. Credit cards are at the other end of the interest rate scale, since there is no collateral securing the loan, and rates can be over 20% or more. Predatory loans like title loans and payday loans are even worse. Installment loans have equal monthly payments, whereas revolving loans have changing balances and payments. Loan interest rates can be fixed for the term of the loan or they can be variable. Credit cards typically have variable interest rate and are revolving loans. Auto loans are installment loans with fixed interest rates. Home loans are installment loans but come with various options for fixed or variable rate interest rates.
How do consumers minimize their borrowing costs?
There are several things that matter, such as maintaining a good credit rating, shopping for the most competitive loan terms, using the lowest cost loan types, and not incurring too much debt through overspending, especially on credit cards.
And how do lenders decide on making consumer loans?
Lenders use what is referred to as the 4 C's in consumer lending. First, there's capacity, which refers to your present and future ability to meet your loan payment obligations, including whether you have enough income to pay your bills and other debts. Second is capital, which refers to the value of your assets and net worth. 3 is character, which refers to how have you paid your bills or debts in the past. Your credit report is one tool lenders use to consider your willingness to repay your debts. Fourth, collateral refers to property or assets offered to secure the loan. The use of collateral tends to decrease the interest rate.
Tell us about credit ratings and having a good score.
Lenders evaluate how much of a credit risk they are taking when lending money. Companies such as Fair Isaac Corporation or FICO and Vantage Score create credit scores to help lender decisions. High credit scores allow lower borrowing costs. FICO scores range from 300 to 850. Very good scores start at 740. Lenders evaluate how much of a credit risk they are taking when lending money. Companies such as Fair Isaac Corporation or FICO and Vantage Score create credit scores to help consumer lending decisions. High credit scores allow lower borrowing costs. FICO scores range from 300 to 850. Very good scores start at 740, and 670 to 739 is considered good. Having a strong credit rating is critical in keeping borrowing costs low and avoiding the trap of predatory loans with extremely high interest rates. Credit scores can affect insurance costs, employment prospects, and your ability to rent a property. There are several factors that affect the credit score: how much debt a person has, how many accounts there are, how long they have been held, how much of the credit line is actually being used, the timeliness of debt payments, negative public record information on collections, judgments, and bankruptcies, how many inquiries there are. More inquiries lower the score. Some are considered soft inquiries that don't reduce a credit score, such as when checking multiple lenders when shopping for a new loan.
Okay. If someone has a low credit rating, how do they go about improving it?
If you are first building your credit, making regular payments for utilities, rent, and a car payment is a start. You may be able to get a gas credit card as a first step. If you are established but having debt problems, start to pay your bills on time and pay off excessive debt are fundamental actions you can take. Your credit rating can be based on inaccurate information, and you may be in such steep debt that you can't make all the payments required. You can work on this yourself, as we will explain, or you can work with a credible credit consulting firm. These are the basic steps. Obtain a copy of your credit report. Review it for errors and request an investigation for any errors you find. Contact your creditors to explain your situation. Negotiate payment plans with your creditors when you have some money to pay them. Opt out of receiving unsolicited offers for credit cards to avoid the temptation of applying for them.
I like the last one. Remove temptation. How does someone get a copy of their credit report?
The Federal Fair Credit Reporting Act requires that each of the three credit reporting agencies, that's Equifax, Experian, and TransUnion, provide you with a free copy of your credit report as you request once every 12 months. You can order these reports through a website called www.annualcreditreport.com. In general, credit scores are not provided free with the report unless you get scores from lenders you are working with. Check your report for errors such as debts that aren't yours. If you think you have an error on your report, contact the credit reporting agency and write a letter disputing the error. Keep a copy of the letter for your records. The credit reporting agency is required to investigate within 30 days of receiving your letter. Identity theft is an increasing problem. The Federal Trade Commission has an identity theft hotline at 1-877-ID theft, which is 438-4338, or you can visit the website www.ftc.gov/ID theft. Credit scores consider several factors. 35% of the score comes from the payment history. 30% is the ratio of revolving credit balances to the actual limits. 15% of the score comes from the length of the credit history. 10% comes from the amount of new credit, and 10% comes from the types of credit in use, such as credit cards versus mortgage or installment loans.
And then you mentioned getting your annual copy of your credit report. That one is free, but would you get all three, or you only will have to choose one?
You can choose whether to get each of them, or you might even stagger them, like get one first, and then if you see some errors, work on getting those fixed before you order the next two. And then you can wait a little while and make sure that they're fixed when you order them, would be one strategy. Or you could just order one, and if it's clean, then order the other two and just make sure they're also clean. But you only get these once per year for each credit rating agency. So you can just decide how you want to best handle that.
Okay. And then all of them, do they rate differently?
They may have a few different sources they consult, so there could be some differences in them. It shouldn't be too much, but there can be some. That's why it's important to check each of them.
Okay. And is the scoring system the same for all three of them, about the same? Or is it like
Well,
they use a different scoring system?
well, these are credit reporting agencies, so they don't necessarily compute your credit scores. Those are computed by Fair Isaac, FICO, or Vantage
Mm,
Score, and they tap into this information to do that. But their services aren't free. You usually have to pay for a credit report, a credit score to see your actual score. Or sometimes you may get it as an extra service with a credit card, for instance. And my bank lets me have a free credit score. So there can be different ways to get a free report. And of course, if you're applying for a loan, then you can usually get the lender to show you what your credit score is when you do that.
okay, perfect. Thank you for sharing that. So basically, if you want to see just the score, you can see if sometimes your employer would provide that, or your bank or credit loan, or even if you apply for something and they request it, you might be able to ask for a copy. But then if you want to check if there's any discrepancies or everything is normal and go more into details, that is going beyond the score, then you want to get your annual copy and you get one free copy for each different bureau. No, those are not bureaus, but you get one copy for the three main agencies, and then you can verify to make sure that your information is accurate, your addressing, your employment, whatever information they share. So like Mark said, if you want to maybe start with one, if it's clean, then you can order the others, making sure that the information is uniform across all three. But then if there's an error in one, you want to file in a complaint, wait, then once they have a resolution, file a request the other one to make sure that you are clean. And if you need to, again, file a complaint, you can do so and then order the next one. So those are different strategies that you can use, but I just wanted to make sure that you understand the difference, okay?
And this is very important. There's lots of mistakes that happen in these. I had a friend whose name was Mike Ryan, and there was another Mike Ryan that lived in the same apartment building as he did, who had bad credit, and so he got some of the other Mike Ryan's dings on his own credit file. So don't take this for
Wow.
granted.
Yeah. And personally, I had the same. I had to call a few times and they told me it was fixed, but it was not. It was the wrong company. They made me, I mean, they did not make, they reported that I was working in the company I never worked with, I had no affiliation with. And every time I will reach out for them to resolve the issue, they would tell me it's resolved. But then when I reorder my thing, because I didn't do what Mike said, where you can reorder within that same year, to me it's resolved. I've forgotten about it. And then another time I'm like, okay, let me see what's going on. I will reorder my report and I see that the same company is still there. And I told them already twice that I don't work there and I don't even know what company it is. So pay attention and stay on top of it. Don't do what I did where they say it's resolved and I take their word for it. Go the extra length and make sure that it's actually resolved before you forget about it.
Good point.
Okay, the next question is bankruptcy a good solution when someone has too much debt to pay?
Bankruptcy is a process that allows individuals to have a fresh start by giving up all but some specified assets they have, and in return, they get debt discharged. It's a drastic solution, and it shouldn't be the first thing to consider. There are certain debt types and situations where not all debt is just discharged, such as student loans. A bankrupt person will have a difficult time borrowing at reasonable rates again for up to 7 to 10 years until a favorable credit history is reestablished. Consult a bankruptcy attorney if you believe you may be a candidate for a bankruptcy. But first, look at credit counseling or debt consolidation.
Hmm. And then I know you mentioned reach out to an attorney, but when do you know that that is your best option, bankruptcy, that you have no other option? So you, I guess you reach out to any credit counseling companies to see if they can help you, or you work with the creditors to see how you can mitigate. Sometimes they might be willing to forget some, or they will give you like a payment plan. Or how do you know like this is it that you have to file for bankruptcy? Is there a way to know?
Well, I guess I would just suggest to people that you look for more sophisticated sources of advice to talk to before you do that.
Okay.
Certainly, credit counselors are supposed to help you with these things. Let's take medical debt, for instance. Hospitals charge people with no health insurance way more than they recover from insured customers. And so they're usually very willing to negotiate on the amounts that they have billed people. And so an experienced credit counselor can probably help you come up with a payment plan that the hospital would be just fine taking on, and you wouldn't have to go bankrupt. But it's hard for anybody to know these things. That's why professionals can help. Accountants might be another source of help. Sometimes it's really obvious, like if you have that really big medical disaster and all of a sudden you have $100,000 of medical bills, then that might be pretty obvious. But it's just a tricky exercise. And so my suggestion is to start with the credit counseling side and or accountants to see what they can come up with. And then next, when you're discouraged about that, then you can go to a bankruptcy attorney and see if you could get help that way.
That's a good point. And don't be afraid, even if you, before you even get to a credit counseling company, because they also charge a fee, don't be afraid to reach out to the creditors and see if you can negotiate. I remember I have a friend, she's doing cancer treatment, so she has a lot of bills, and there's a lot that is not covered under her insurance. So by doing so, unfortunately, now she knows how the insurance company works. And every time when she gets a bill, there's a time frame for you to wait, and then you can reach out to them and negotiate. And because they don't want to lose on getting nothing, they rather get something that they would be willing, like Ma said, they'd be willing to negotiate with you, especially that they charge insurance companies much lower as they would if you had no insurance or whatever the scenario is. So don't be afraid to reach out to the creditor and try to negotiate. And if they are unable to lower the balance, they might be willing to give you a payment plan. And as you go, if it's insurance or medical or whatever, as you go there, voice it is that this is my situation, and is there something they might be able to even reroute you to any programs that they may have for people in your situation that be able to help and willing to either cover the premium on your behalf or reduce it for you. So don't be afraid to ask. Don't be afraid to reach out before or after the fact to see what you can do.
And just one more point, we're going to talk about debt consolidation next. And so lenders that provide the loans for debt consolidation can also be a free source of advice on this question, because they may have good solutions with their own products that can help you get out of the situation you're in without having to look further at negotiating with creditors and or going all the way to bankruptcy.
Good point. Thank you. So, are there other good ways for people in too much debt to get back on track?
Definitely. And this information could pay for itself many times over. Debt consolidation or refinancing can be used to lower payments and hopefully interest rates. Using a lower cost loan with a longer repayment term and paying off the other loans with the proceeds could lower your monthly payments and interest costs. If your car has no loan secured by it because you paid it off, perhaps, you might be able to borrow money against or using it as collateral and then pay lower interest rate than on credit cards. If you own a home equity credit line could have lower interest charges and payments than your other debts. Another technique is a balance transfer card. You can search on, quote, best balance transferred cards, unquote, and find companies who could allow you to get a new credit card and transfer balances from the high interest cards and pay zero interest for 12 to 18 months, depending on the offer. There is usually a balance transfer fee, often 3%, and some cards have annual fees. Another benefit is you will save money by not incurring interest costs on new charges on the original card if you pay the full balance off each month. The above techniques don't mean you shouldn't be working hard to reduce your debt balances. One technique called the avalanche method involves making extra payments to retire your debts in order, starting with the highest interest rates first, and then moving to lower interest loans as each one is retired. Maybe you have a credit card with a 24% APR as your highest cost loan to work on first. If you can't turn it into a 3% annual cost with a balance transfer, then start with this one, unless there are higher ones. And after you pay it off, move to the next highest interest rate. A second technique called the snowball method involves paying the smallest debts first, then moving to larger debts. This second method, though it may have higher interest costs, has a powerful psychological effect by showing faster success at eliminating debts and lowering monthly minimum payments. This is especially true if you are near the end of a car loan's term, for example. Each of these methods are successful and they have their own fans.
Okay. Let's go back to refinancing for a minute because I want people to have a full picture because I refinanced my car at some point. Mark, you can tell me if I'm wrong or not. I did not like it, and I don't think that I will refinance again because what I realized when I refinanced my car, but it depends on your scenario. I was almost done with paying off the car, but I felt that when I applied for it, that my monthly payments was too high. So I wanted a lower monthly payment. So I went in, I applied, I got a lower, but I didn't realize that to me it's like in a sense it's double pay. Why? Because the balance you extend like the time I was because let's say the first one was maybe 350. I only had 2 years left, right? And then now I went and I got a new loan because I refinanced. I was paying maybe 200, but instead of the 2 years, now I was left with 7 years. So even though I am paying less on a monthly basis, in the long run, I paid more.
That's a good point. If you extend the length of the repayment, then you will, and you take that long to repay it, you will pay more in interest. And so where this can be helpful is if you free up money to pay credit card loans that are at higher interest rates, then you're saving money. Then you could be saving money overall because now you have more to work with on the higher cost loans, even though you're paying more for the car loan. And you can still make payments above the minimum levels to retire a loan faster than the amount of time they have allowed it. That's okay to do. And the only time you have to worry is if there's a prepayment penalty that gives you a fee for finishing a loan payment earlier than planned. It's getting rarer in loan programs, but there are still some around. You just have to check and make sure you don't get one of those if you don't have to.
Yeah, so pay attention. And then when I was done, I repaid it off, like he said. I paid early and I was charged again. So I'm at, you don't know. I didn't do the research. I didn't know. I just was thinking I want to pay less. But after reflection, is that, oh, actually, I paid more. So going in, make sure that you do your due diligence and that you know what you're getting yourself in, not like I did, blinded, and then you can make an informed decision. Okay.
A lot of people have credit card balances and they're paying over 20% interest. And so think hard about whether you can use a balance transfer technique to take your existing balance on your credit card, move it to a zero interest card with only a 3% balance transfer fee. Instead of paying 22% interest, pay 3 for the first year. And then, of course, you want to still pay that down eventually. But now you've at least lowered your interest costs and you can make the same payment and it could all go toward principal instead of interest. and that'll help you retire that debt faster.
Yeah, that's a good point. And look, some of them they have like 24 months where there is no interest, the introductory rate or whatever they call it. So look for those. If you get those, make sure that you pay as much as you can. If you can even pay it all in that time frame, that is even better so you gain it. So again, you wanna go about it with a strategy. Don't do what I did where I was just focused on one objective. Look at the big picture, have a strategy before you make the decision. And are there some loans to avoid?
Yes, there are businesses that target people with low credit scores and offer loans with very high interest rates. They're called subprime or predatory lenders. Payday loans and title loans are example of this kind of loan. They have extremely high interest rates, way higher than credit cards, which you can see in their truth in lending statements disclosing the APR. Other lenders may try to sell higher interest rate loans by telling the buyer their credit is worse than it really is. Still, other lenders bury fees and other charges in the fine print in their loan documents. Knowing your credit rating, shopping for the best loan programs, and reading the loan documents are important in getting good loans. Loan to own programs are available, and they tend to have fees and interest rates as high or higher than credit cards. Furniture could be acquired this way. Same as cash programs may give you time to use the product before paying the whole purchase price. The catch may be a high interest rate if you don't have the entire amount needed by the deadline.
Tell us what is important about auto loans.
Auto loans make purchasing a car much more feasible. You may be able to get 100% financing with loan lengths up to 5 years, sometimes even longer. Longer term loans have lower payments, but you pay more in overall interest. Keep in mind that if you're buying a new car, the dealership makes a substantial amount of money from the lending side. If you can talk to lenders before you visit a dealership, you can get a read on the market interest rates to get a better deal. I have had good luck with credit unions, which are nonprofit institutions. Yet when I went to dealerships with an interest rate target, they seemed to have competitive offerings. Since cars go down in value with time, it is more economical to keep a car longer. Even a certain number of millionaires buy used cars, as cars lose a lot of value in the first years.
Ads for lease cars show very low monthly payments. Is that a less expensive way to get a car?
Generally, leasing is more expensive for consumers. The lease payments you see in ads generally are not the whole story, as there are down payments, potential damages to pay, and extra charges above a mileage limit. At the end of a lease, you turn in the car and you have nothing left for your investment, or you have to buy it. If you compare that to owning a car and then selling it after the loan is paid, there is a substantial value typically left that makes owning a better value.
What is important to know about mortgage loans?
These are the largest loans most people have, so it is important to get the best rate and watch markets afterwards to look for opportunities to refinance for even lower rates. During a recession is usually the best time. There are many programs and they can be confusing. The 30-year fixed rate loan is the most common choice. You can usually get a lower interest rate with a 15-year loan term, but the payments are higher. You may end up better off by buying more house instead of paying a loan off faster, if that is the trade-off. Adjustable rate loans have lower first year payments, but you can get into trouble later if the rates go up. So be sure you understand the maximum levels and whether you could afford them or could sell the house. If interest rates are unusually high, that may be a good time to go with an adjustable rate loan, expecting them to go down in the future. If you have a good idea of how long you will live in a house, You may want to look at a program with rates that are fixed for periods up to only 5 years and then adjust. And that may save money on interest compared to the 30-year fixed rate loan program. It is important to shop rates before deciding on a lender, as fees and rates can vary. I've had better luck working with mortgage brokers than mortgage bankers. Brokers have offerings from a large variety of wholesale lenders to work with. There are options to pay upfront charges called points to buy lower interest rates. Home sellers may prefer to pay some or all of these in a negotiation rather than drop the purchase price. You should always pre-qualify before you make offers to improve your bargaining position and know what costs you are facing. Sometimes good lenders can help you improve your credit score to get a lower rate by fixing credit report errors, updating your file for loans you have paid off, or by consolidating debt. Happy house hunting. Another product is a home equity credit line. This is a revolving account secured by your home as collateral that has a variable interest rate and is in second position behind your first mortgage. You typically are limited to total debt from the two loans being less than 80% of your home's value. This product has low payments and a much better interest rate than credit cards. It does increase your risk of losing your home if you don't make the payments on both home loans. It is a good tool for debt consolidation, so you should think about it for saving money on your interest rate costs.
Great points. Also, like Mike mentioned, credit unions, sometimes if you're not working with a broker, you can also look at credit unions. Sometimes they have better rates than the actual bank. And the other point is if you're a first-time home buyer, they have resources to help you with the down payment, with how to manage that new expenses, what to look for. So make sure that if you're a first-time buyer, that you look for the resources available to you. Don't feel like, oh, because I don't meet this criteria, I don't fit into that, or I don't have money for the down payment, that owning a home is not part of your journey, because they have resources. They even have nonprofit organizations that will help you. They have resources if you making below a certain threshold. Just look for it, basically, and you would find something for you. Do you want to add anything on that, Mark?
Just again, to make the point that your credit score is very important. It can save you so much money and give you so many more options for borrowing. So make your payments, don't neglect them, and check your credit reports and do everything you can to keep your credit rating strong. And it's not just for lending, it can even affect job hunting and insurance rates and other things. So it's really, really important that you do your best to keep a good credit rating.
And something just came up to me because it happened to me. Please, please do not do what I did and some women do. Please, please, please don't. Do not lend your credit to someone. And let me explain myself. Sometimes you might buy something for your boyfriend, for your husband, or whatever the scenario is. If you do really trust the person, know that the person will be able to repay back, because if they default and you're the one that has your name on that car or on that house, and for some reason they default and they don't pay, then you are left with it. If you are not able to fulfill that payment, then you will mess up your credit. There's too many women that we even saw in the scam with Tinder, where you trust a man, you're infatuated by him, and you will give him money that you don't have in the first place, or you be willing to sponsor him or do things for him, and you trust that he will repay back, you will trust that he will make the payments, and then as you go in you find out that he's not, and because of your situation, you're not able to pay for 2 cars or whatever the scenario, and then you find out that your credit card is messed up or you have to even resell the car, but he's not even ready to give you the car. So there's so many headaches that come with that. We can discuss it more further. You can reach out, but don't do it. Don't do it. Just don't do it. The next thing we're gonna be talking, if you don't have anything to add, is the homework.
Yes, here's 3 good things to do in the area of debt. First, make a list of each of your loans and have columns for the amount owed, the credit limit, the annual percentage rate or APR, the monthly payments, and the term left to pay it off, or the date that you have to pay it off. Include totals for all the loan balances, credit limits, and monthly payments. Next, divide your monthly loan payments by your monthly income and see how the result compares to 32%, which is a limit for getting good home loan rates. Rank the loans for early payoff for the avalanche method, which is from high interest rates to low interest rates, and by the snowball method, from the lowest balance to the highest balance. How does the interest rates you are paying compare to returns on savings investments you are getting? Considering adjusting your budget to pay the highest cost loans or lowest balance loans sooner. A second exercise, if you're carrying balances on your credit cards, search for balance transfer card opportunities, as I suggested earlier. Calculate how much interest you will save in the first year by paying the transfer fee instead of the interest. Your savings will be even bigger by not paying interest on the new charges if you pay your balance in full each month on your original credit card. And then third, obtain and review one of your credit reports from the 3 credit bureaus at www.annualcreditreport.com. If you find things to correct, you may want to wait to get your other 2 reports until after there is time to check on the corrections, since only 1 per year at each bureau is free.
And then 1 per year, is it the calendar year from January to December 2024, or is it like from when you started? Is it like, let's say if I put it in October, is it October to October, or how does it work?
Yeah, I believe it's just from the time that you request a credit report, you can't get the next free one for another 12 months.
Okay, perfect. Thank you. So again, you will have a link in the description of the homework. And again, do your homework. It's not enough for you just to listen if you're not taking action. And I'm going to keep repeating, do the homework. We're giving you the information, but it is useless until you take steps. Okay, so do the homework. If you have questions, you can reach out to me. I will be more than happy to assist. If I cannot, I will reroute you to the right organization or person or whatever. But do the homework, please. Do the homework and share, because this is important. Financial literacy is important for everyone, that you be a woman, that you be a man, that you be a young adult or a teenager, whatever. Share that knowledge, and then yeah, do the work. Do you have any closing thoughts, Mark?
Well, certainly debt is one of the very tricky areas for many people. And so trying to restrain your use of debt is important. Trying to not take the predatory debt, keeping your credit score high so you don't have to use those programs that are very high interest rates, managing your debt in general. That's just a great area to concentrate on so that you can have more money available for building wealth and resilience, to keep yourself financially healthy and grow your own resources.
Perfect. Thank you. And be patient with the process, especially if you're trying to improve your credit score. It might take some time. And even if you decide to work with an organization, because they will close your account, so you will see that there is a dip, it will go down before it goes up. So be patient and trust the process and keep doing what you need to do. And thank you for being with us. And again, share, and do the homework. Until we see you again, have yourself a wonderful day or night. Bye.
Bye all.
Thank you for joining me on this journey. If you enjoyed this episode, I'd be incredibly grateful if you could share it, leave a review, and rate it. It means so much and it helps spread this message further.